Can AI influence your tax audit selection? Have you ever wondered if artificial intelligence can play a role in whether you get selected for a tax audit? Well, it turns out that it can. Tax authorities, including the Internal Revenue Service, are increasingly using artificial intelligence to improve their audit selection process. This technology analyzes vast amounts of taxpayer data to identify patterns and risks that may indicate underreporting or noncompliance. Artificial intelligence systems use algorithms that involve data matching, predictive analytics, and machine learning. Data matching compares the income you report with information from employers, banks, and financial institutions. If there are discrepancies, it raises a red flag. Predictive analytics look for patterns that suggest tax avoidance or evasion, flagging returns for further review. Machine learning helps these systems improve over time by learning from past audits and outcomes, refining their risk models continuously. The Internal Revenue Service has implemented artificial intelligence models funded by recent legislation. These models aim to enhance the selection of cases for examination, reducing the burden on compliant taxpayers. By focusing on returns that are more likely to contain errors or fraud, the audit selection process becomes more efficient. Artificial intelligence tools can process large volumes of tax documents, extracting relevant information, and creating risk profiles for different taxpayer categories and industries. They pay special attention to complex areas like large partnerships, corporations, and employment tax returns, where traditional audit coverage has declined. Many taxpayers make common mistakes that can increase their audit risk. One mistake is assuming that audit selection is random. Understanding how artificial intelligence targets specific risks can help you avoid behaviors that might trigger an audit. Another mistake is failing to keep accurate and complete records. Since artificial intelligence relies heavily on data matching, discrepancies can increase your audit risk. Overlooking complex transactions or partnerships can also attract scrutiny. Engaging in questionable partnerships or complex tax arrangements without proper advice may lead to increased attention from tax authorities. Ignoring professional advice can be another pitfall. Consulting with knowledgeable tax professionals who understand these technologies can help prevent mistakes that could result in audits. When you do receive an audit notice, responding properly is essential. Timely and accurate responses can help you avoid escalation or penalties. To minimize your audit risk, prioritize full compliance and transparency. Ensure that all income and deductions are accurately reported. Utilize the Internal Revenue Service's educational resources and seek guidance from professional tax advisors for complex situations. Keeping organized records will help you quickly verify reported information if you are audited. Be cautious with aggressive tax strategies or partnerships that may be flagged by artificial intelligence risk models. By avoiding common legal mistakes and maintaining good practices, you can reduce the likelihood of being selected for an audit.